Now on BBC News, the latest from New York and around the world. Business Today.
Live from New York at the opening bell, this is Business Today. Wall Street turns cautious ahead of Nvidia's high-stakes results on Wednesday, which could turbocharge tech stocks or sink them. Also coming up, uneasy truce. China and Germany pledged to strengthen economic ties as they try to end months of trade tensions between the world's number 2 and 3 economies. Plus reprieve for Reeves. UK government bonds rise after Friday's steep sell-off on reports the Chancellor has scrapped plans to raise income tax. And bullet from Beijing. Japanese shares from airlines to department stores are rattled as China urges its citizens not to visit amid tensions over Taiwan. Welcome to Business Today, live from New York. I'm Michelle Fleury. And it's a cautious start to the week here in the United States. On the stock markets in New York, investors are braced for results from AI chip giant Nvidia out after the bell on Wednesday. Now that could put some wind back in the sales of tech stocks, or could it spark a renewed sell-off? Results from retail giants Walmart, Home Depot and Target will also give a steer on the health of the world's biggest economy. Also in the mix, US jobs numbers for September, delayed, of course, by that government shutdown. They are now scheduled for release on Thursday. And minutes from the last Federal Reserve meeting, well, that will feed into the feverish debate about the future of US interest rate cuts. For more on all of this, let's bring in our markets guest, Chris Brigati, Chief Investment Officer at SWBC here in New York. Chris, good to see you this morning. Let's start with Nvidia. Obviously, you've got on the one hand Jensen Huang saying, earnings could be blockbuster again. At the same time, we're hearing reports that Peter Thiel, a very wealthy investor, has sold his entire stake in the company following hot on the heels of SoftBank last week.
Yeah, I mean, there's a lot of interesting things and developments happening within the space, and NVIDIA is certainly, at the epicenter of that. So these important data releases, important thoughts on the market from people like Peter Thiel is something that we got to keep an eye on and be thoughtful of. Regardless, I think that the stock is going to continue to do well in the long run. So I'm not thinking that there's any reason to evacuate any positions and suddenly run for cover.
Of all the things happening this week, which event, if you like, are you going to be paying most attention to? Is it the economic data? Is it the results? Is it Nvidia's earnings?
Personally, the economic data. I mean, the fact that we went through the extended shutdown of 43 days, which really kind of created this vacuum of information, really makes it a little bit more important to be able to see what information we can get and see that we have not been able to get for a period of time here. So personally, and as a bond market kind of thought process person, I'm really aware of and kind of want to know what's going to happen in that space. So I'm really looking forward to seeing what that data is going to mean. And I expect the bond market, at least, to be relatively cautiously uneventful until we do get that data on Thursday.
But I mean, you've got the Fed obviously meeting in December, question marks over whether or not they will cut rates. And this jobs data that you're talking about, it's September. I mean, it's pretty backward looking.
It is. It's very backward looking, but we kind of don't know what's been happening for the past 43 days, really. So to be able to get some sense of information is going to be helpful. I don't think it's going to suddenly open up the floodgates of understanding where things are and where they could be. But at least it does provide us some data to be aware of and thoughtful of. So that's where I'm really focusing on it. Not that it's going to suddenly solve all our problems and we're going to know exactly where we lie. To your point, the Fed is going to be meeting and providing a release in the coming days. In December. And therefore, that's going to be a very important event. And right now, the odds are about 50-50 between a cut or no cut.
We will keep watching that space. Chris Brigati, thank you for joining us this Monday morning.
Thanks for having me.
Germany's finance minister and China's vice premier have used a meeting in Beijing to agree to try and strengthen economic ties and ease trade tensions that have been growing in recent months. Now, the world's number 3 and number 2 economies have found themselves increasingly at loggerheads, even as many of Germany's car makers and big industrial companies rely more heavily on China for their profits. But Berlin is increasingly worried. It says Chinese firms benefit from heavy state support and can undercut German companies, while Beijing tightens its own export controls. Here's a little of what Lars Klingbeil had to say after meeting Chinese Vice Premier He Lifeng.
I received assurances from the Chinese side that German and European concerns about export restrictions on rare earths and critical raw materials are being taken seriously, and that we want to find joint solutions that ensure reliable access and reliable supply chains. We also discussed overcapacity in key sectors such as steel, solar energy and electric mobility.
We hope that German side can leverage the influence and leading role as the core members of the European Union to push China and the EU to move towards the same direction so as to properly resolve economic and trade frictions through dialogue, build an open and cooperative international economic environment and jointly resist unilateral bullying.
Well, we can get more on all of this with Gregor Sebastian, an expert on economic relations between Germany and China at the independent research firm Rhodium Group, and he joins us live from Berlin. Gregor, let's start with this. What are you hearing from German companies on the ground in China? Are they worried or are they adapting? Because China has for a long time been a huge cash cow for some of them.
Hi, Michelle. Yeah, I think we're hearing both. I mean, they're absolutely worried. You can see that if you just look at the recent financial statements, right? Just looking at the big German car makers, most of them already starting last year have had to issue several profit warnings, not just related to US tariffs, but increasingly because of their deteriorating position in China. On top of that outlook in the Chinese market, you now have the concerns that Chinese competition is also going to be an issue for them in third markets and at home, and that China, as we also just heard in the clip you played, has that leverage over intermediary components and raw materials that could really lead to production stops, including in Europe.
So what is the answer then? I mean, is it more de-risking and moving further away from the Chinese, or, as we're seeing today with these talks, is there an attempt to kind of knit closer together?
I think we have to look at that from the company perspective and the government's perspective, right? As a company, a lot of the firms actually saying we need to invest more into the Chinese market, and that is de-risking for us because it basically shortens supply chains and means that if there are additional trade tensions, well, you know, that sort of China market is more isolated and we can still continue to operate there. Looking at this from the government's perspective, or also from the Europeans' perspective, de-risking is more about striking new trade agreements and also potentially using more trade defense instruments. I think so far the German government has been a little bit more concerned about the potential effects, what that could have on the bilateral relationship with China. They're concerned about retaliation. But I think as we are seeing that China is more coercive in terms of using some of its own leverage points, that discussion in Berlin is definitely accelerating as well.
Yeah, I mean, what options does Germany have if it does want to curb Chinese competition without hurting its own exporters?
It's extremely tricky. I think in the short term, they're definitely looking for a truce, right? A truce in the sense of getting those raw materials back into the markets where they're needed, because frankly, for the next 5 years or so, there's no way that Germany can produce certain minerals or refine them without China. But in the long term, I think there are now discussions to invest more at home and with partners. We just had the meetings in Canada at the G7 level. There are efforts underway to diversify jointly within the G7 and also other like-minded partners. There's also talks about potentially restricting access to the European markets. The German government has just announced that when we look at 6G, right, Chinese providers are no longer welcome on security grounds.
Gregor Sebastian of the Rhodium Group, thank you so much.
Thank you.
Now, the UK government bonds are on a roller coaster again, bouncing back after a sharp sell-off on Friday. That was sparked by reports today that Chancellor Rachel Reeves has torn up plans to raise income taxes in next week's budget. Why should you care? Because those bond yields, the government's borrowing costs, are still sitting near a one-month high. And when big economies wobble, the ripple effects of that can reach global markets, including the US. Callum Pickering from Peel Hunt explains why investors are so jittery.
It's important to understand what drove that movement. It was markets factoring in a little bit less in terms of interest rate cuts from the Bank of England. It was markets anticipating a bit more inflation over the next few years as a result of this change. And why did that happen? Well, if the government would have raised income taxes, yes, on its own, that would have been very bad, but it would have helped bring inflation down, it would have reduced borrowing, and it would have opened the door for the Bank of England to offset it with interest rate cuts. Markets on its own would not be happy about the income tax increase, but with this combination of reducing inflation and cuts from the Bank of England, markets like that, which is why interest rates had fallen in anticipation of this potential policy decision, and then reversed sharply when it was revealed that it wasn't going to happen.
To Japan now, where tourism-related stocks have tumbled after China warned its citizens not to travel to the country as tensions rise between Tokyo and Beijing over Taiwan. Shares in Japanese department store chains and airlines were hit by concerns Chinese tourists, who make up around a quarter of visitors to Japan, may now stay away. The argument stems from comments by Japan's new Prime Minister, Sanae Takaichi, who suggested this month that Japan could take military action if Taiwan was attacked by China. All of this as the latest figures on the economy show the Japanese economy contracting as it feels the impact of US tariffs, as Professor Sayuri Shirei of Keio University explained earlier.
Yes, so there was already early signal at the end of October when Prime Minister Takaichi met Xi Jinping, and Xi Jinping already warned about this Taiwan issue. So, and then Takaichi made it clear in the diet that Taiwan's threat is equivalent to Japan's threat. So I think this really created a lot of dissatisfaction and anger from China. And so China tried to trying to ask Japanese Prime Minister to change her remarks. So this is raising a lot of attention. Chinese tourists account for about 20 to 30% of total, inbound tourism. So it's very important. So I think, but at this moment, Chinese government is sort of discouraging it. So it's not prohibiting. So we have to see to what extent this, recent action will influence the tourism to Japan.
Now, in other news, US airlines are resuming normal operations after aviation authorities lifted restrictions brought on during the government shutdown. A tenth of all domestic flights were affected by a shortage of air traffic controllers who were asked to work without pay. And before we go, just a quick recap. The market's pretty much flat, slightly in the green. And that's all from us here on BBC News. Thanks for watching.